Welcome to Financial Tea with Damilola. If you have ever wondered how to start your investment journey, you're in for a ride because today we'll be talking about how to invest in the safest way possible. Today, we'll be lending to the government and also pulling our funds together and getting something from it. So sit back and sip the tea with me today. What are Treasury Bills? These are short-term loans that you're giving the government. That's just a simple way of explaining what it is. So you're giving the federal government a loan, and they in turn pay you something on the loan. Treasury bills are discounted bills. So the interest that the government gives you on those bills, for example, if they're going to give you 12% on your money and you wanted to invest 100,000 naira, so because they are discounted bill, you only be paying 88,000. And at maturity, that's at the end of 1 year, you get what? You get 100,000. So that 12% that you're supposed to get as interest on that 100,000, you get it earlier. So you pay 88,000. That's why we call it discounted bill. Guess what? That 12,000, you can spend it now, knowing full well that you're getting 100,000 at the end of the year. And guess why we also say that they are discounted bill and they are very good, they yield good return on money. You see that 12,000, you can also decide to invest it in something else again. So you can see how your money is compounding and growing. And then another advantage of Treasury bill is, like I said earlier, they are backed by the government. So if you're investing in US Treasury, they are backed by the United States. If you're investing in Nigeria, they are backed by the Federal Republic of Nigeria. If you're investing in Ghana, they are backed by the government of Ghana. So that's how Treasury bill works. And then for now, Treasury bill has actually been giving good return in the year 2025 that we're in, and in Nigeria, and even in the United States for the whole 2024-2025, Treasury bill got to about 4.5%. because of inflation and post-COVID and Ukraine war, etc. So it was actually very high, because before now you could not get a 2.5% on Treasury bill. That's the US Treasuries. And then also in Nigerian context, you should know that like 2 years back, Treasury bill were trading at 5, 6. The interest rate you get on Treasury bill, we actually call it discount rate. And why it's called discount rate is because you are not actually putting in that 100,000 you initially wanted to put in. You are putting in 88,000, remember, and you're getting 100,000 at the end of the year. That means you invested 88,000, you're going to get 12,000 on that money, because you're going to get 100,000 at the end of the year. But if you calculate what you've actually done, it's no more 12,000 on 100,000. It is 12,000 on 88,000. So that is actually what you invested. So if you calculate that, you'll be able to come up with your yield. 12,000 divided by 88,000 will give you 13.67%. So at the end of the day, you're not just getting 12%, you're getting more if you calculate yield. Do you understand? So that's actual return on your money. So that's why it is called discounted bill. So the interest you also get on it is called a discount rate for Treasury bill. The real advantage is the fact that they are very safe relatively, and they are relatively secured, because the government of the country where you are investing in, they back it. They are the ones borrowing from you anyway, so it's backed by that country. And currently in Nigeria, interest rate is yielding 16, 17, 18%. So if it's 18%, just know that your return is actually 21.6 thereabouts percent. I will also say Treasury bills are short-term investments. We have the 90-day bill, we have the 182-day bill, and we have the 364-day bill. So if it's just 90 days you want to invest in, you can go get that bill, then the 182-day bill or the 364-day bill. If you go to your bank, just walk into any of your bank and tell them you want to buy Treasury bills. They will explain to you how it works, and then you can put your money. So if it's 1 year you want, at the end of 1 year, you get your 100,000. Or if emergency comes and you needed your money maybe 6 months time or 8 months time, the bank will buy from you, those banks or the apps or wherever you're investing from. Or you are not guaranteed to get that 100,000, because wherever it is trading at that point in time is where they will buy from you. So all these bills, even though they are issued for 1 year, every day is being traded on the interbank market. So where the market is where they will buy back from you. So if the bill you bought at 12% discount is currently trading at 11% or 10%, you'll calculate it, prorate everything, and that's what they will give you. And if you are lucky, it's trading at 13, 14, 15, which is higher than where you bought it, you also get that. So you need to be aware of that risk that is involved. But if you are holding till maturity, so you bought 90 days or 182 days or 364 days, if you're able to hold until those maturity dates, you are going to get your full return. And the bond also is the same thing. Where the bond is trading at that point in time is where they will buy back from you. So you need to know that risk exists before you consider. But it is one of the safest investments. But like we all say, every investment carries a risk. Let's talk about mutual funds now. What are mutual funds? As the name suggests, it's funds that is pulled together mutually, and then it's being managed by a fund manager who is a professional, who then invests your money in various diverse investment grade things. They invest in Treasury Bills, they invest in bond, they invest in a lot of other things. They invest in stock markets. That's mutual fund. But the good news about mutual fund is you don't have to have big money. Some funds start with very low amounts for you. So you can be as low as 5,000 for you to have access to the mutual funds. And it's actually also a good investment if you're a beginner. So you can also walk into some banks. Some banks offer it. They offer mutual funds. So in mutual funds, your principal is safe. So when I say they don't guarantee returns, I mean the interest on your money. That is what they mostly don't guarantee. So every month they will send you what the fund has done. They can tell you, oh, this month we're able to achieve 7% of return for you. Next month we're able to. And then we have some types of fund that are open-ended fund and closed-ended fund. The open-ended fund, that means you can go in and go out at whatever time you like. While the closed-ended fund, you may be charged for withdrawing or breaking your fund whenever you like. So you just have to also find out, is this a closed mutual fund? Is this an open-ended fund before you invest your money? Mutual fund, you are diversifying your income. They don't invest in one thing. They invest in a lot, but it's managed by professionals. So, but like I said, the downside rate, you don't get as much as you may get if you just go and invest in Treasury bill or bonds. You can even get more depending on market conditions. So don't say, oh, they told me 7%, next month it was not now 7%. No, so they will not guarantee you a return. They will just give you historical return they've had. So whatever you get, but it's going to be higher than just putting your money in a savings account. For people that are very confused on investment and don't even know where to start, I always just advise them that they should try mutual fund first. It doesn't require too many calculations, but just know that your return is going to be lower than if you just jump into Treasury bill directly or bond directly. These are just information that you have. They are not investment advice. Thank you for watching.